what do I do with my portfolio in this kind of environment?
Yeah, that's a loaded question, guys. So look, my view, is everyone wants a pullback to invest into. I hear that all the time. But then when the pullbacks happen, they're for scary reasons, like geopolitics issues or the Fed pivoting. So I think you need to develop a framework with which to be unemotional and say, okay, pullbacks here, I'm investing. Now, are we at that level? 10% pullbacks are not that unusual. 15% pullbacks are not that unusual. 20% pullbacks are unusual. I think we're getting in a range where you should put money to work. I don't, we're past the 10% pullback. We weren't at the close yesterday, but now we are. We'll have to see what happens here. But if we're below 10%, I think you start to put money to work. And if we're below 15%, which would be around 4,100, which wouldn't surprise me, I think you put more money to work. I don't think we're going to have a bigger correction than that, because that usually, treasuries, there's not been a big flight to quality. Equal weighted S&P has outperformed cap weighted. Financial conditions aren't wavering that much. So I think we're in a range where, you've got to be clinical. And you have to say, here we go. Here's the pullback I've been waiting for. I think you invest into.
Andrew, talk to us a little bit about the regional piece of that equation. In this kind of market sell-off that you've seen really since the start of the year, a lot of money has been put to work in emerging markets especially. You've seen EM equities actually outperform or perhaps perform not as badly as developed markets. And now you just had Anne-Marie Horder say, well, European markets are bouncing back in a way that American markets aren't. Talk to us a little bit about the regional divergence in where you would invest.
Sure. So my view, pivoting to the S&P, while I liked EM at the beginning of the year, my view was that this was going to be a kind of a very moderate year for equities versus where we started the year. 5,000 was 5,100 would have been, kind of single digit. It wasn't that attractive. And therefore, as you think about other parts of the world, like emerging markets that did not do well last year, they look pretty attractive. And that's because the dollar really took the wind out of the sails for emerging markets last year. Having said that, with the S&P now down to the low 4,000s, the risk return dynamics for our market here becomes more attractive. And so I wouldn't necessarily run out and sell U.S. equities here to buy emerging markets, given the magnitude of the relative underperformance of the U.S. market year to date versus EM. So to me, to sell U.S. equities and buy EM here would be selling into weakness and buying into strength, which I'm not sure is a very smart thing to do right here.